In this presentation, we will take a look at part 3 of an example problem related to a private college, looking at the closing entry process. You'll recall that the objective in the closing entries is to take all the dark blue accounts, the income similar type of accounts, those temporary accounts, and close them out to what would be the equity section in a for-profit type of organization, here closing them out to the net income section. Now, when you think about a closing process in a for-profit type of organization, or if you have learned the closing process, you may have learned a 4-step type of process, closing out the revenue accounts to a clearing account called income summary, closing out expenses to that clearing account called income summary, closing out income summary then to where we want to ultimately go within equity, whether that be retained earnings or a capital account, depending on if it is a corporation or a partnership or limited or a sole proprietorship, then closing out either dividends or draws, whether it be a corporation or proprietorship, to retained earnings or a capital account. Here, we could do that whole process, however, in one step, closing out revenue and expenses and possibly draws or dividends, if we so choose, into either revenue or the capital account. We're going to be doing here more of a kind of like one-step close process, closing out both revenue and expenses at the same time. However, we will have multiple journal entries in that we're going to be closing out based on these factors of with restrictions and without restriction items that are labeled within our trial balance. So we here are going to be considering those items are going to be of our major concern within the trial balance to close them out. Now, our biggest journal entry will be our first one, and those are going to be the ones related to items without restrictions. And that's going to be included in any type of revenue account that doesn't have the restrictions. And most of the expense accounts then aren't going to have the restrictions and therefore will be included in this first journal entry as well. I've marked them off here on the side. Our objective, once again, is to make these accounts go down to zero. So as you think of constructing the closing entry, we're basically doing whatever we need to do to make all these dark blue accounts zero. So we have the tuition and fees without donor restrictions. It has a credit balance. We're going to do the opposite thing to it, debiting it to make it go down to zero. And then I'm going to skip down here to the investment income without donor restrictions. It has a credit. We're going to then debit it to make it go down to zero. We then have this is the amount for the contributions without restrictions. And we are going to be debiting it to make it go down to zero. It's going to be another income type of account. Then we've got the 2070, which is down here. It's going to be the unearned gain on investment without donor restrictions. It has a credit in it. We're going to be debiting it to make it go down to zero. Then we're going to be taking a look at the expense type of things, or first the kind of contra sales. This is the tuition fees. Here's the tuition and fees. It's basically a contra revenue account. It has a debit balance similar to an expense. We need to make it go to zero, so we'll do the opposite thing to it and credit it. Then we have the instruction expense. The instruction expense down below has a debit balance in it. We're going to credit it to make it go to zero. We then have the academic support expense, has a debit balance. We're going to credit it to make it go down to zero. We've got the student services expense, debit balance. We're going to credit it to make it go down to zero. We've got the institutional support expense, debit balance. We're going to credit it to make it go to zero. If we take these debits and subtract out the credits, let's do it just for the fun of it. We've got the 234,307 plus the 1900 plus the 2390 plus the 2070 minus the credits 21770 minus the 122452 minus the 31518 minus the 37790 minus the 28710 gives us the difference, the plug, what we need, a debit of 1,573 in order to be in balance. Okay, posting this out then, if we were to post this out, looks something like this. We have the tuition and fees, bringing the balance down to zero. We've got the investment income, bringing the balance down to zero. We've got the contributions without restrictions, bringing the balance down to zero. Unearned gain on investment, bringing the balance down to zero. Then we have the tuition and fees discount, bringing the balance down to zero. We have the instruction expense, the academic support expense, the student service expense, and the institution, all four bringing the balance down to zero for each. Then the difference going to the net assets, similar to a retained earning account or a capital account, depending on if corporation or sole proprietorship. However, it's going to the net asset account that is without restriction. So we want to go to the net asset without restriction. It has a credit balance in it, as does most retained earnings in equity type of accounts. It's going to be going down because we're debiting it here to the 102,627. Next, we're going to be closing out items that do have restrictions, but not yet the endowments. So we're going to be taking a look at the investment income with donor restrictions. It's got a credit in it. We're going to do the opposite thing to it and debit it. We've got the contributions with donor restrictions with relation to time, not the endowment. And it's going to have a debit balance to go down to zero, or need a debit balance to go down to zero. And then we have the unearned gain on investment with donor restrictions with regards to the scholarship having a credit in it. We need to debit it to make it go down to zero. The credit then, summing those three up, will add up to $3,871. It going to what would be similar to retained earnings or capital account corporation or a sole proprietorship. This being here, however, net assets with restrictions. So if we were to post this out, it would look something like this. We would have the investment income with donor restrictions. It's got a credit in it. We're going to debit it, making it go down to zero. We've got the contributions with donor restrictions. It's got a credit in it. We're going to debit it, making it go down to zero. We've got the unearned gain on investments. It's got a credit in it. We're going to debit it, making it go to zero. Finally, we have the net assets with donor restrictions. It has a credit in it. We're going to credit it this time, increasing it to the 238.80. Next, we're going to be closing out the items related to the endowment. So we only have a few things left. You can notice we have a lot of zeros. Our objective is being achieved. We're whittling away at this. We're almost there. We have the contributions with restrictions related to the endowment. It has a credit. We need to make it go down, so we're going to debit it. Then we've got the unearned gain. It has a credit in it. We need to make it go down. We're going to debit it. And then the credit is going to go to the net assets with donor restrictions. Here's the credit, net assets with donor restrictions. All right, so if we post this out, we're going to say here's the contributions. It has a credit in it. We're going to debit it, making it go down to zero. We've got the unearned gains. It has a credit in it. We're going to debit it, making it go to zero. The difference then going to the net assets with restrictions. It has a credit balance. It goes up in the credit direction to the 240, 230. Now we just need to take care of those last two accounts, which are the net assets released satisfaction of purpose restriction without donor restrictions, and the same with donor restrictions. So the one that, if we take a look at this, we're going to close out the one first that has without restrictions. It's got a credit balance in it. So we're going to do the opposite thing to it and debit it. And the credit's going to go to the net assets, the one without restrictions. So of course we're matching up the word without restrictions, without restrictions. So we're doing whatever we need to do to make this go to zero. The other side going to the net assets without restrictions. Posting that out, we have the debit here, bringing this balance down to zero. The credit going to the net assets without restrictions. It has a credit balance in it, going up in the credit direction to the credit balance of 110,207. Finally, we have this last one that's going to be in the net assets released satisfaction of purpose restriction with donor restrictions. It has a debit balance in it. Therefore, we're going to credit it, putting it on the bottom. Then we're going to debit the net assets with donor restrictions. So that's going to be kind of like our equity account, but with restrictions. Posting that out, then we're going to say that the net assets with donor restrictions is here. Going to be bringing it down as we debit it to this. Then we've got the net assets released. That's going to be down here at the 7580. We are going to credit it, making it go down to zero. This leaves us, of course, with our post-closing trial balance. Our post-closing trial balance only having basically the balance sheet accounts. We've got the assets, we've got the liabilities, and then we have what would be similar to the equity section here being the net assets section. We have nothing below that. We have no temporary type of accounts, revenue and expense kind of related type of accounts.